Thank you. So far, we've looked at 3 different types of investing. First, the evidence shows you should avoid using actively managed funds altogether. So what should you use? Well, either passively managed funds or funds that are designed to capture the returns of specific risk factors, or indeed a combination of the two. We've also seen the importance of matching your portfolio to your capacity for risk. Ultimately though, whether or not you succeed as an investor is essentially up to you.
The way that they behave, particularly in the presence of money, isn't what anybody would expect. It's irrational, because in essence people behave in ways that mean that they lose money. And you can predict that they'll lose money because of the way that they're actually behaving. So this gap between what you would expect people to do rationally and what they actually do when they're put in the situation of finance and money and investment and risk and uncertainty, there's this hole. Some studies have shown 3 to 4% a year is being dropped by investors purely because of making poor buying and selling decisions. Now that's just one bias. That's just one type of issue that they're facing. So, you know, if people are consistently making mistakes in terms of when they buy and when they sell stocks over a lifetime, that's thousands, hundreds of thousands, millions of pounds. And you scale it up across the industry, it's billions of pounds a year.
Thank you. It's because the returns you end up with are so dependent on your behaviour that self-awareness is so important. Understanding your own personality, what your goals are and what biases you're particularly prone to will help you to manage that behaviour in the years to come.
You have to know your own temperament, your own appetite for risk, your own ability to overreact in highly emotional situations. Every investor needs to know that about themselves. And then kind of lay on a framework of investing that fits that personality. If you are a highly emotional person who's susceptible to the big ups and downs of the markets, having a pretty conservative investment style is the right way to go for you. And I think a lot of investors try to manage around optimizing down to the basis point. What's the best portfolio for me to own? And then in 2009, the market falls 50% and they're out and they're panicked. And at that point, all the optimization that you did before doesn't matter anymore. So if you can nail down the behavioral aspect of investing, all of the optimization that we layer on top of that matters less and less. It's not that it doesn't matter, it's just of less importance than other aspects of investing.
A constant temptation investors face is to try to time the market, but it's almost impossible to do successfully. Between the 2 world wars, the bursar of King's College, Cambridge, and the man responsible for the college's investment strategy was the famous economist John Maynard Keynes. He tried to get into the market when prices were about to rise and out again before they fell. But even Keynes missed the most infamous market crash of all.
Keynes ran portfolios both for himself and for his college amongst other investors for about a quarter of a century. And one of the key things that he learnt about investing was the great difficulty, or indeed the futility, of market timing. So by market timing, what we mean is trying to pick the points when you should be in or out of the equity market, as opposed to being in bonds or cash, for example, because those were the 3 major asset classes that were available to him, in addition to property, in the 20s and the 30s. He pored over economic and industrial statistics, and indeed he founded the premier economic and statistical service of its day. Despite all those advantages, as well as being a great economist, he found it very difficult to time when to get in and when to get out of the equity market. And probably the prime example of that is that in October 1929, when the London stock market crashed, along with New York, he was still very heavily into equities.
You'll often see supposed experts speculating in the media about the likely impact on the markets of major political events like elections and referendums. But almost invariably, the best thing to do at times like these is to leave your portfolio exactly as it is.
Political events are very difficult to predict in advance. A couple in particular, Brexit, Trump, a few months before that, they were completely off the radar. But what's really interesting is even if you had been able to predict some of these events in advance, being able to predict how the markets were going to respond to those events once they happened was also very difficult. So we saw, for example, in the UK that markets didn't collapse. The stock market didn't collapse after the Brexit vote. The currency did actually, but stock markets didn't. In the US, we actually saw the opposite. The stock market started to surge on the expectation of some expansionary policies. And again, most investors, even so-called informed investors, wouldn't have been positioned for that.
If I want a real stream of income that's diversified, and for the long term, equities are quite a good thing to be invested in. You take a risk coming out, you take a risk going in that you know better than anybody else, and throwing that dice will cost me several percent, of which I'll only know about a very small part of it. All the rest will be in transaction costs. So again, start with fundamentals, stick with the fundamentals, and you're likely to do an awful lot better than people that are trying to switch in and out all of the time.
In fact, human beings are hardwired to make poor investment decisions. When markets soar, the reflexive nucleus accumbens fires up at the back of the brain's frontal lobe, and we instinctively want to buy. But when markets tumble, our brain's amygdala floods our bloodstream with corticosterone. Fear kicks in, and we're overwhelmed by the urge to sell. Indeed, it's during a crash or market correction that investors tend to make their biggest mistakes.
So how should you react? A lot of that is about looking inward. What is your risk tolerance? Has anything changed in terms of your knowledge about the markets and your ability to outperform the markets? In overwhelming likelihood is no. Whether it's now March 2009 and you've lost half your money, you still can't outperform the markets. You still can't know what's going to happen 12 months hence. But that doesn't mean that the decline hasn't altered your circumstances. It might paradoxically be that as a result of a great loss, you have a lesser tolerance for risk. That's a personal thing, and you should treat it as that.
Stock markets have always been subject to periods of extreme volatility and always will be. You can't be sure how you're going to react until you find yourself in just that sort of situation. The important thing is to be prepared. Understand how markets work. Understand your plan. But most important of all, understand yourself. The biggest threat to your success as an investor is you. Everyone can benefit from good financial advice.
Value is often perceived as being investment performance, which is one thing that as advisors we cannot control.
But a good advisor can add 3% a year to your net investment returns.
Just in fees alone, we shaved £80,000 per annum off the costs. That very first response was, wow.